Section 3.1 to 3.3 Understanding the Efficient Frontier, Section 3, Portfolio Optimization on the Efficient Frontier, 3.1 Risk and Return Trade-off, Understanding the relationship between risk and return on the efficient frontier. On the efficient frontier, the relationship between risk and return is a fundamental concept in portfolio management. It illustrates the trade-off between the level of risk taken and the expected return that can be achieved. Here's how the relationship between risk and return is understood on the efficient frontier line. The efficient frontier represents a set of optimal portfolios that offer the maximum expected return for a given level of risk or the minimum risk for a desired level of return. On the efficient frontier, portfolios that lie to the left of the line are suboptimal, as they either offer lower returns for a given level of risk or higher risk for a given level of return, increasing risk with increasing return. Generally, as you move along the efficient frontier from left to right, the expected return of the portfolios increases. This is because higher returns typically come with higher levels of risk. Portfolios that offer the potential for higher returns are often associated with higher volatility or uncertainty in their performance. Risk diversification. The efficient frontier demonstrates the benefits of diversification in managing portfolio risk. By combining assets with different risk profiles and low correlations, investors can achieve a certain level of return while minimizing the overall risk of the portfolio. Diversification allows for risk reduction through the offsetting of individual asset risks and the potential to capture the benefits of non-perfectly correlated assets. Optimal risk-return trade-off. Each point on the efficient frontier represents a portfolio with a specific risk level and expected return. The optimal risk-return trade-off depends on an investor's risk tolerance and return objectives. Some investors may prefer portfolios with higher risk and potential for higher returns, while others may prioritize lower risk even if it means lower expected returns. The efficient frontier allows investors to choose a portfolio that aligns with their risk preferences and return goals. Individual risk preferences. Investors have different risk preferences, and the efficient frontier provides a range of portfolios to accommodate various risk-return trade-off preferences. Investors can select a portfolio from the efficient frontier based on their risk tolerance, investment goals, and individual circumstances. Adjusting portfolio allocation. As an investor's risk tolerance or return expectations change, they can adjust their portfolio allocation along the efficient frontier. Moving to a portfolio with higher expected return requires accepting a higher level of risk, while choosing a portfolio with lower risk may result in lower expected returns. The efficient frontier allows investors to visualize and make informed decisions about their desired risk-return trade-off. It's important to note that the efficient frontier is based on historical data and certain assumptions about asset returns, variances, and correlations. The future performance of assets may differ from historical patterns, and market conditions can change. Regular monitoring and adjustments to the portfolio allocation are necessary to maintain the desired risk-return characteristics and adapt to evolving market conditions and investor objectives. Analyzing the risk and return characteristics of portfolios along the efficient frontier. Analyzing the risk and return characteristics of portfolios along the efficient frontier provides insights into the trade-off between risk and return and helps investors identify optimal portfolios based on their risk preferences and return objectives. Here's how portfolios along the efficient frontier can be analyzed in terms of risk and return. Risk analysis. Standard deviation. The standard deviation measures the volatility or dispersion of returns for a portfolio. Portfolios with higher standard deviations have greater fluctuations in returns and are considered riskier. As you move along the efficient frontier from left to right, the standard deviation generally increases, indicating higher levels of risk. Diversification benefits. Analyze the diversification benefits of portfolios along the efficient frontier. Portfolios that lie to the left of the efficient frontier offer suboptimal risk-return trade-offs because they either have higher risk for a given level of return or lower returns for a given level of risk. Diversification allows for risk reduction by combining assets with low correlations, and portfolios along the efficient frontier represent the optimal diversification benefits. Risk-adjusted measures. Consider risk-adjusted measures such as the Sharpe Ratio or the Sortino Ratio. These ratios take into account both the portfolio's return and its risk to provide a measure of risk-adjusted performance. Portfolios with higher risk-adjusted ratios are considered more efficient, as they offer higher returns for a given level of risk or lower risk for a desired level of return. Return analysis, expected return. Analyze the expected return of portfolios along the efficient frontier. Portfolios that lie to the right of the efficient frontier generally offer higher expected returns. Investors can select a portfolio that aligns with their return objectives based on their risk tolerance and the level of return they are seeking. Trade-off between risk and return. Examine the trade-off between risk and return. Portfolios with higher expected returns typically come with higher levels of risk. Investors must assess their risk tolerance and determine the level of risk they are willing to accept to achieve their desired level of return. The efficient frontier allows investors to visualize and evaluate different risk-return trade-offs. Performance comparison. Compare the performance of portfolios along the efficient frontier to evaluate their historical returns. Historical performance provides insights into how portfolios have performed in different market conditions. However, it's important to note that past performance does not guarantee future results, and portfolios should be regularly monitored and adjusted based on changing market conditions. Optimal portfolios, selection based on risk preferences. Investors can choose portfolios along the efficient frontier that align with their risk preferences. Portfolios to the left of the efficient frontier offer lower risk but potentially lower returns, while portfolios to the right offer higher returns but with higher risk. The specific portfolio choice will depend on individual risk tolerance and return objectives. Sensitivity analysis. Conduct sensitivity analysis to understand how changes in assumptions or market conditions affect the risk and return characteristics of portfolios along the efficient frontier. This analysis helps investors assess the robustness of their portfolio allocations and consider different scenarios. It's important to note that the risk and return characteristics of portfolios along the efficient frontier are based on historical data and certain assumptions. The future performance of assets may differ, and market conditions can change. Regular monitoring and adjustments to the portfolio allocation are necessary to maintain the desired risk-return characteristics and adapt to evolving market conditions and investor objectives. 3.2 Capital Market Line, CML. Exploring the CML as a tangent line to the efficient frontier. The capital market line, CML, is a tangent line to the efficient frontier in portfolio theory. It represents a line that connects the risk-free rate of return with the portfolio with the highest Sharpe ratio on the efficient frontier. Here's an exploration of the CML as a tangent line to the efficient frontier. Risk-free rate. The risk-free rate of return is the rate of return an investor can earn with certainty, typically from investing in low-risk assets such as government bonds. It represents the minimum expected return an investor would require to take on additional risk. Tangent portfolio. The tangent portfolio is the portfolio on the efficient frontier that has the highest Sharpe ratio. The Sharpe ratio is a measure of risk-adjusted return, calculated as the excess return of a portfolio over the risk-free rate divided by the portfolio's standard deviation. The tangent portfolio represents the optimal combination of risk and return, given the risk-free rate, risk-return trade-off. The CML illustrates the risk-return trade-off for a given investor. It shows the optimal portfolios that can be achieved by combining the risk-free asset with the risky portfolio along the tangent line. Portfolios on the CML are constructed by allocating a portion of the investor's wealth to the risk-free asset and the remaining portion to the risky portfolio. The allocation is determined by the investor's risk preferences. Efficient portfolio. Portfolios on the efficient frontier offer higher expected returns for a given level of risk compared to portfolios that are not on the efficient frontier. The CML connects the risk-free rate to the tangent portfolio, allowing investors to construct portfolios that lie on a straight line with varying levels of risk and expected return. The CML provides a benchmark for evaluating the risk-return characteristics of portfolios and determining the optimal allocation between risk-free and risky assets. Capital allocation line, CAL. The CML is sometimes referred to as the capital allocation line, CAL. It represents the set of portfolios that can be formed by combining the risk-free asset and the risky portfolio. The CAL extends beyond the tangent point to the efficient frontier, allowing investors to choose portfolios with higher expected returns but also higher levels of risk. Portfolio construction. Investors can construct portfolios along the CML by adjusting the allocation between the risk-free asset and the risky portfolio. The specific allocation will depend on the investor's risk tolerance and return objectives. Investors with higher risk tolerance may allocate more to the risky portfolio, while those with lower risk tolerance may allocate more to the risk-free asset. Evaluation of performance. The CML provides a benchmark for evaluating the performance of portfolios. Portfolios that lie above the CML are considered superior in terms of risk-adjusted returns, while portfolios below the CML are considered suboptimal. Investors aim to construct portfolios that maximize their risk-adjusted returns by investing in portfolios that lie on or above the CML. The CML and the Tangency Portfolio provide insights into the optimal risk-return trade-off for a given investor. They help investors determine the allocation between risk-free and risky assets and construct portfolios that balance risk and return according to their preferences and objectives. Understanding the risk-free rate and its role in portfolio optimization. The risk-free rate is a key concept in portfolio optimization and plays a crucial role in determining optimal portfolio allocations. Here's an explanation of the risk-free rate and its significance in portfolio optimization. Definition: the risk-free rate of return is the rate of return an investor can earn with certainty, assuming no risk of default or loss of principal. It is typically associated with low-risk investments such as government bonds or treasury bills. The risk-free rate serves as a benchmark for evaluating the expected returns of other investments. Risk and return trade-off. The risk-free rate is important in portfolio optimization because it represents the minimum level of return an investor would require to take on additional risk. It forms the foundation for assessing the risk and return trade-off in investing. By comparing the expected returns of various investments to the risk-free rate, investors can determine if the potential returns justify the additional risk. Capital market line, CML. The risk-free rate is a fundamental component in the construction of the capital market line, CML. The CML is a tangent line to the efficient frontier and represents the optimal portfolios that can be formed by combining the risk-free asset with a risky portfolio. The risk-free rate is the starting point on the CML, as it represents the expected return of a portfolio with no risk. Portfolio optimization. In portfolio optimization, the risk-free rate is used to assess the risk and return characteristics of different portfolios. The objective is to construct a portfolio that offers the best risk-adjusted return, given an investor's risk tolerance. The risk-free rate is typically used as the benchmark for the risk-free asset within the portfolio optimization framework. Sharpe Ratio. The risk-free rate is a key input in calculating the Sharpe Ratio, a widely used measure of risk-adjusted return. The Sharpe Ratio is calculated as the excess return of a portfolio over the risk-free rate divided by the portfolio's standard deviation. It helps investors compare the risk-adjusted performance of different portfolios and select the one that provides the highest risk-adjusted returns. Optimal asset allocation. The risk-free rate is also used to determine the optimal asset allocation within a portfolio. By incorporating the risk-free rate, investors can construct portfolios that balance risk and return according to their preferences. Portfolios along the capital allocation line, CAL, which extends from the risk-free rate to the Tangency Portfolio on the efficient frontier, represent different allocations between the risk-free asset and the risky portfolio. Risk premium. The difference between the expected return of a risky asset or portfolio and the risk-free rate is known as the risk premium. The risk premium compensates investors for taking on additional risk beyond the risk-free rate. It is an important factor in evaluating the attractiveness of risky investments and their potential to generate higher returns. In summary, the risk-free rate serves as a benchmark for evaluating the risk and return characteristics of other investments. It helps investors assess the trade-off between risk and return and plays a crucial role in portfolio optimization by guiding asset allocation decisions and risk-adjusted return calculations. 3.3 Sharpe Ratio in the Tangency Portfolio. Calculating and interpreting the Sharpe Ratio as a measure of risk-adjusted return. The Sharpe Ratio is a widely used measure of risk-adjusted return that helps investors assess the performance of an investment or portfolio relative to its level of risk. It quantifies the excess return earned per unit of risk taken. Here's how to calculate and interpret the Sharpe Ratio. Calculation. Calculate the excess return. Subtract the risk-free rate of return from the investment's average return over a specific period. calculate the standard deviation, measure the volatility or variability of the investment's returns over the same period, divide the excess return by the standard deviation to obtain the Sharpe ratio. Sharpe ratio equals average return, risk-free rate, / standard deviation. Interpretation: positive Sharpe ratio. A positive Sharpe ratio indicates that the investment or portfolio has generated an excess return over the risk-free rate relative to the level of risk taken. A higher positive value implies a better risk-adjusted performance. Negative Sharpe ratio. A negative Sharpe ratio suggests that the investment or portfolio has underperformed the risk-free rate and has not adequately compensated investors for the level of risk taken. Comparing Sharpe ratios. When comparing investments or portfolios, a higher Sharpe ratio generally indicates a more favorable risk-adjusted return. It means that the investment or portfolio has achieved a higher return per unit of risk compared to alternatives. Risk-adjusted performance. Sharpe ratio as a risk-adjusted measure. The Sharpe ratio allows investors to evaluate investments or portfolios by considering both the level of risk, as measured by standard deviation, and the level of return, excess return over the risk-free rate. It helps investors assess whether the achieved return justifies the level of risk taken. Evaluating performance relative to a benchmark. The Sharpe ratio can be used to compare the risk-adjusted performance of an investment or portfolio against a benchmark. If the investment's Sharpe ratio is higher than the benchmark's, it indicates that the investment has generated a better risk-adjusted return. Limitations. The Sharpe ratio relies on historical data and assumes that past performance is indicative of future results. It also assumes that returns are normally distributed and that volatility, as measured by standard deviation, adequately captures risk. These assumptions may not hold in all cases. Adjusting the risk-free rate. The choice of risk-free rate used in the Sharpe ratio calculation is crucial. It should be consistent with the time horizon and currency of the investment. Typically, the risk-free rate is based on government bond yields or other low-risk fixed-income securities. The Sharpe ratio helps investors make informed decisions by considering both risk and return. However, it should be used in conjunction with other measures and factors to form a comprehensive assessment of an investment or portfolio's risk-adjusted performance. Identifying the optimal portfolio on the efficient frontier using the Tangency Portfolio. To identify the optimal portfolio on the efficient frontier using the Tangency Portfolio, follow these steps. Calculate the Sharpe ratio. For each portfolio on the efficient frontier, calculate the Sharpe ratio. The Sharpe ratio is computed as the excess return of the portfolio over the risk-free rate divided by the portfolio's standard deviation. Determine the Tangency Portfolio. Identify the portfolio on the efficient frontier with the highest Sharpe ratio. This portfolio represents the optimal trade-off between risk and return among all the portfolios on the efficient frontier. Find the risk-free rate. Determine the current risk-free rate, typically represented by the yield on government bonds or other low-risk fixed-income securities. Construct the optimal portfolio. The optimal portfolio is constructed by combining the risk-free asset and the Tangency Portfolio. The allocation to the risk-free asset and the Tangency Portfolio is determined based on the investor's risk tolerance and desired level of return. Determine the weight on the risk-free asset. The weight on the risk-free asset is calculated as the risk-free rate divided by the Tangency Portfolio's Sharpe ratio. Determine the weight on the Tangency Portfolio. The weight on the Tangency Portfolio is calculated as 1 minus the weight on the risk-free asset. Allocate the portfolio. Allocate the portfolio based on the determined weights. The allocation to the risk-free asset provides a guaranteed return, while the allocation to the Tangency Portfolio captures the additional risk and return potential. Assess the optimal portfolio. Evaluate the risk and return characteristics of the constructed optimal portfolio. Calculate the portfolio's expected return, standard deviation, and other relevant risk measures to ensure it aligns with the investor's risk preferences and return objectives. The Tangency Portfolio represents the optimal portfolio on the efficient frontier because it maximizes the Sharpe ratio, indicating the best risk-adjusted return among all portfolios. By combining the Tangency Portfolio with the risk-free asset, investors can construct a portfolio that strikes the ideal balance between risk and return based on their risk tolerance and return objectives.